Welcome back. Wells Fargo borrowing from a tale of two cities and its recent fintech coverage and initiation wrote, calling it the best of times and the worst of times for the sector. But analysts managing to find what they call the Fab Five of fintech, which includes Affirm. That was our mystery chart, if you were watching. Now, joining me now to discuss this is Jason Kupferberg. He's a senior research analyst at Wells Fargo Security, initiating on these names. Jason, thank you so much for joining us here. Because it's your initiation, I'd love to sort of start with your big thesis about the space before we get into your Fab Five.
Absolutely. Well, thanks very much for having me. And the reason why we chose it was the best of times, it was the worst of times, is because on the one hand, you've got a sector with $2 trillion plus in market cap, strong balance sheets, good cash flow, solid profitability, secular tailwind in terms of ongoing cash displacement opportunity. So that all sounds great. But on the other hand, what we've seen from an investor sentiment standpoint is worries around competition, market share, disruption, stable coins, you name it. And so you have this dichotomy out there, and we think sentiment is too negative. Hence, we see numerous opportunities in the space.
Okay, so numerous opportunities, but you've got five names, the Fab Five of fintech, she tries to say carefully. Sort of tell us about, yeah, exactly. Can you go through some of these names? Tell us why you picked them, why you said some opportunities. So I also think there may be some names that you're not thrilled about, which we'll get to next.
Terrific. So I would start, I'll go in alphabetical order here. So Adyen is the first of the Fab Five of payments. Adyen, we think, has a best-in-class back-end tech stack. They've been expanding into new addressable markets in-store, as well as going down market into small to mid-sized business. And they still have their bread and butter e-commerce business as well. And we think that they're going to have solid 20% plus top-line growth for at least a couple of more years. We have Affirm on this list as well, which you mentioned earlier, and we believe that the secular opportunity for Affirm and buy now, pay later in general remains robust. Buy now, pay later is only 8% of U.S. e-commerce, and while there are still some potential cyclical unknowns in terms of the lower-end consumer, we think that these secular tailwinds can help to offset that, and we've been very impressed with the management team and the execution there. We have MasterCard also, which we believe still has a tremendous competitive moat, is keeping up very much with all the new technologies and payments, whether that be stablecoins, agentic commerce, and continues to enjoy a terrific cash flow profile as well. And you can really play offense and defense at the same time owning MasterCard. And we have a similar thesis for Visa. What I would also say for both of them is that they've diversified away from their core businesses into value-added services very effectively. And then finally, Toast is the last of the Fab Five, and we believe that they continue to enjoy a very strong competitive position in the point-of-sale space.
I have seen that pop up more places at point of sale. That's a good point. But I love that you didn't shy away from some underweights. I know sometimes that's harder to do for a sell-side analyst, but tell us about why these two names you are less thrilled about.
We are underweight rated on both ADP and Paychex. And just to be clear, this is a cyclical call. This is not a structural call. These are still solid business models. However, based on our analysis, when you have a period of potentially rising unemployment and lowering of interest rates, that's not the right time in the economic cycle to be owning these names. And so those we want to avoid for those reasons.
I want to go back to some of these buy now, pay later names like Affirm, which is in your Fab Five. It's a very interesting business model. We know it doesn't stand alone now. There are other competitors in the space. But things have changed a little bit with reporting for credit agencies for delinquencies. I know you've said only 8% of e-commerce is comprised of this buy now, pay later. But when you see adoption pick up for Affirm, is that a good thing or a bad thing? A good thing for Affirm, but I guess I mean writ large for the economy and what it says about the consumer's ability to spend.
We believe that buy now, pay later is actually a more consumer-friendly product than a traditional credit card. A traditional credit card has revolving features. You pay compound interest. You pay late fees. It's very unconsumer-friendly. With Affirm, there are no late fees. There is maximum transparency in terms of what the consumer owes and when they owe it. And we believe that the pay in 4 classic variety of buy now, pay later, 4 equal installments over 6 weeks with 0 interest is extraordinarily consumer-friendly and can help the average U.S. consumer stretch their dollars a bit further, and that may come in especially handy around the holidays.
Yeah, I know retailers like the option. Of course, more and more have been adding it at checkout. It says it does help to increase transactions.